Germany, the heart of Europe's economy, once a global leader in manufacturing, exports, and engineering. But today, this powerhouse is faltering. Since 2018, Germany's economic growth has slowed significantly, with zero growth recorded in the past 2 years. A new book, Germany, From Boom to Gloom, explores why the country's economic miracle has turned into stagnation, and what it might take to turn things around. A major factor? Germany's energy policy. In 2021, before the Russian invasion of Ukraine, 34% of the mineral oil, 53.6% of the natural gas, and 50% of hard coal originated from Russian sources. Germany has, since the invasion, been forced to admit it was a terrible mistake to become so dependent on Russian oil and gas. Another problem has been the German Energiewende. Germany has pursued aggressive green energy goals through its Energiewende policy. Yet, Germany became vulnerable by relying on Russian energy imports and scaling down nuclear energy. Now, with the global energy crisis, electricity prices in Germany are 4 times higher than in the US, the highest in Europe. This puts immense pressure on households and industries, pushing manufacturing costs even higher. Germany's close trade ties with China, its largest trading partner, fueled economic growth for years. But now, that dependency has backfired. China is advancing in sectors Germany once dominated, like automotive and high-tech machinery. The result? Germany's trade balance with China has shifted dramatically, moving from a trade surplus to a deficit of over $1 billion in 2022. China now leads the world in electric vehicle production, a market Germany once dominated, leaving German automakers struggling to keep up. And then there's infrastructure. Once known for its world-class public systems, Germany now spends only 1.4% of its GDP on infrastructure, one of the lowest in Europe. Compare this to Switzerland, which spends 4 times as much. Digital investment tells a similar story. Germany ranks 17th out of 20 OECD countries in digital spending, with Germany's share of GDP on digital infrastructure less than half of what the US and France spend. This underinvestment is stifling innovation and reducing efficiency across sectors. Another issue is Germany's high corporate tax rate. At 28.8%, it's significantly above the EU average of 18.8%. Combined with strict environmental regulations and extensive red tape, this high tax rate makes it challenging for German businesses to compete globally. Many companies cite these regulations as a deterrent to expanding their operations in Germany, leading some to relocate elsewhere. And finally, Germany's demographic crisis. By 2050, the population aged 65 and older will grow by 41%, while the working age population will shrink by 23%. Nearly half, 49.7%, of German companies are already reporting difficulty finding skilled workers, a record high since surveys began in 2009. With fewer young workers and a growing elderly population, Germany faces an uphill battle to sustain economic growth. So, can Germany rise again? There are potential solutions: lowering corporate taxes, increasing infrastructure investment, pension reforms, and digitalization. These steps could help Germany reclaim its role as Europe's powerhouse. But action must be taken now, as Germany faces growing economic competition and internal challenges. Discover the full story and what lies ahead in Germany, from boom to gloom. Available now.